Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, what if I told you that the single most powerful institution on Wall Street is quietly moving its operations onto a blockchain?
I think most people would instantly assume they're just, buying Bitcoin or launching some trendy new crypto coin.
Right, exactly. Because whenever we see Wall Street and blockchain in the same headline, we picture hedge funds trying to make a quick buck. But according to the recent analysis we're looking at today, they are absolutely not doing that.
No, not at all. It's actually a complete high-tech overhaul of the underlying plumbing of the U.S. financial system. It's entirely structural.
Yeah, and our mission for this deep dive is to unpack this massive new pilot program by the DTCC. And for you listening, if you haven't heard of the DTCC, well, that's kind of by design.
Yeah, they're the Depository Trust and Clearing Corporation. They basically act as the invisible backbone of the entire market.
Exactly. They're the ones making sure that when you buy a stock, you actually get it and the seller actually gets their cash. And they hold over $114 trillion in assets.
Right. They are essentially the ultimate secure vault. So when the data shows an institution like that leaning into blockchain, you really have to pay attention.
I have to admit, though, when I first saw the research, I was super skeptical. I was like, wait, are they just making their own Wall Street crypto token to jump on the bandwagon?
Oh, yeah, that is definitely the natural assumption. But the mechanics here are completely different. The DTCC isn't creating new permissionless crypto coins out of thin air.
Okay, so what are they actually doing then?
They are doing something called tokenized entitlements. Basically, they're taking existing highly liquid assets they already hold safely in their vaults. Things like, Russell 1000 stocks, major ETFs, U.S. Treasuries.
And they're turning those into tokens.
Well, they're generating digital rights to those specific real-world assets on a blockchain.
I was actually trying to visualize this for an everyday investor. And the best analogy I could think of is like a coat check at a fancy restaurant.
Oh, I like that. How so?
So you hand over your physical winter jacket to the attendant, which is the DTCC in this case, and they hang it securely in the back. In return, they give you a little paper ticket with a number on it.
Right. And that ticket is the token.
Exactly. The ticket won't keep you warm, but it represents your absolute legal right to claim that specific jacket. But, a physical coat check still needs a human attendant, right? It doesn't really explain the whole blockchain tech leap.
Yeah, because a physical coat check is basically how traditional finance works today. You rely on a middleman who works set hours. A better way to look at what the DTCC is building is like a high-tech smart locker system.
The smart locker.
Yeah, they still hold the physical asset in an armored locker. But instead of a human handing you a paper ticket, you get a unique digital key.
Oh, and because it's a smart locker, you don't have to wait for the attendant to come back from lunch to get your stuff.
Precisely. The digital key interacts directly with self-executing software, which is called a smart contract. So if you want to give that locker to someone else, you just transfer the key.
And it updates instantly, right? Like 24/7.
Exactly. 24 hours a day, 7 days a week, no human paperwork, no delays. The tokenized entitlement is just that digital key.
That makes so much sense. And looking at the regulatory side of the analysis, things are moving surprisingly fast. The SEC, under the current Trump administration, issued a no-action letter back in December 2025.
Right, which basically gave them a 3-year window to run this.
And just to be perfectly clear for you listening, we're just impartially reporting the regulatory facts from the data here. We aren't endorsing any political administration or taking sides. We're just looking at the policy.
Yeah, and that policy gave the DTCC the green light. The rollout schedule is pretty aggressive, actually. Limited production starts in July 2026, with an official launch targeted for October 2026.
And the players involved are huge, right? Over 50 major institutions are working on this.
Oh, it's a massive roster. You've got BlackRock, Bank of America, Charles Schwab, Goldman Sachs, Robinhood, just this huge blend of traditional finance titans and digital asset firms.
Which kind of forces a really obvious question. If I own, say, 10 shares of an ETF on Robinhood, I don't really care if it's in a traditional database or a blockchain smart locker. The app looks the same to me.
Right, the retail experience doesn't change at all.
So why are these giant banks spending billions to completely overhaul their backend just to tokenize index funds?
Because the real driving force here has almost nothing to do with retail stocks.
Mhm.
The overwhelming demand is actually focused on U.S. Treasuries.
U.S. Treasuries, really?
Yeah, according to MarketWatch data from May 2026, the tokenized U.S. Treasury market is already sitting at roughly $15 billion.
I mean, to put that in perspective, the total U.S. Treasury market is somewhere around $30 trillion. So $15 billion is basically a rounding error.
In the grand scheme, sure, but the growth rate is what matters. U.S. Treasuries serve a very specific vital function on Wall Street. They are essentially the financial duct tape holding the global banking system together.
Because they're used as collateral for practically everything, right?
Exactly. When massive banks borrow cash from each other for their daily operations, they don't just do it on a handshake. They pledge U.S. Treasuries to secure those huge short-term loans.
Let's break down why that's currently a problem, because it explains this whole blockchain shift. In the traditional system, moving that collateral is painfully slow.
It's incredibly clunky.
Right. If Bank A needs to borrow, say, $500 million from Bank B just to settle some trades, they have to route bonds through clearinghouses, use old messaging systems like SWIFT, and wait for humans to verify it.
Yeah, the settlement times were just from another era. Trades often take 1 or 2 full business days to settle what they call T+1 or T+2.
So if a bank only needs that cash for like 3 hours on a Tuesday afternoon, the system literally can't move the collateral fast enough. They are forced to lock it up for a full 24 hours.
Exactly. It's wildly inefficient.
I like to think of it as the by-the-minute rental problem. It's like needing to rent a car to drive 15 minutes down the road for groceries.
Right. But the paperwork takes so long that the rental agency makes you pay for a full 24 hours anyway.
Yeah. Your money is tied up all day for a 15-minute errand that tracks billions of dollars on bank balance sheets every single day.
And that exact inefficiency is what tokenized U.S. Treasuries fix through something called intraday repo.
Intraday repo. That sounds like some serious Wall Street jargon. Can we unpack that?
Sure, intraday just means within the same business day. And repo is short for repurchase agreement, which is basically a collateralized short-term loan.
Okay, so bring that back to the smart locker idea. How does it change things?
Well, because the tokenized bond is just a digital key on an automated smart contract, Bank A can transfer that collateral to Bank B instantly.
Wow, instantly.
Yeah, they borrow the money at 10 a.m., use it, and the smart contract automatically returns the cash and unlocks the collateral at, say, 2 p.m.
So they only pay for the rental car for the 4 hours they actually used it.
Exactly. And a May 2026 study by the DTCC and Finadium found that real-time collateral mobility like this could cut intraday funding costs by up to 50%.
Wait, a 50% cut in overhead? That's massive. Suddenly, all that trapped capital isn't just sitting in a parking lot. It can actually be deployed into the economy.
Right. It becomes super clear that Wall Street isn't doing this to be trendy. It's a pure infrastructure play to make capital infinitely more efficient.
Okay, but this is where I get a little skeptical again. Blockchains are fundamentally closed loops, right? The ledger only knows what's written on it.
Yeah, they're technically blind to the outside world.
So if an automated smart contract is moving a treasury bond at 3 a.m. on a Sunday, how does it actually know what that bond is worth at that exact second? Who is the referee when all the human auditors are asleep?
That is the big technical hurdle. In decentralized finance, they call it the Oracle problem. You can't have automated trades without perfectly accurate real-world data.
So how are they solving that?
According to the recent announcements, the DTCC is fixing this by integrating a network called Chainlink.
Okay, but how does Chainlink work without relying on some guy manually typing in the price and maybe making a typo?
Chainlink is a decentralized Oracle network, so it's not just one computer checking Yahoo Finance. It's a huge web of independent nodes pulling data from premium financial sources.
So they basically fact-check each other.
Exactly. They reach a consensus on the exact price and securely feed that verified data into the blockchain. The DTCC is actually using Chainlink as the data layer for their collateral app chain launching in late 2026.
Oh, wow. So Chainlink acts as the automated referee 24/7.
Yeah, it manages the risk continuously, ensuring the smart contract always values the collateral perfectly,
Yeah.
even in the middle of the night.
So Wall Street isn't throwing away the old system. They're basically building a hybrid. They keep the traditional vault for the physical assets, but plug in decentralized tech to handle the data and the movement.
Hybrid is the perfect word for it, and we actually have concrete data showing this hybrid model works right now.
Really? What kind of trial did they do?
Well, back in May 2026, there was a massive experiment. JP Morgan's blockchain unit, Kinexys, partnered up with MasterCard, Ripple, and Ondo Finance.
That is an incredibly heavy-hitting roster. What exactly were they testing?
They executed a cross-border settlement using a tokenized U.S. Treasury fund, specifically Ondo's OUSG fund.
And doing that traditionally is usually a total nightmare.
Well, completely.
Yeah.
Normally, moving money internationally means routing it through a bunch of correspondent banks using Swift messages. Everyone takes a fee, they operate in different time zones, and it takes days.
It's like a financial game of telephone where everyone takes a cut.
Exactly. But in this trial, they bypassed all of that using atomic settlement. They moved the tokenized Treasury fund across borders almost instantly, completely outside of normal banking hours.
And it actually settled into real dollars.
Yeah. Once the digital asset moved on the blockchain, they used MasterCard's network and JP Morgan's traditional rails to settle it in actual fiat currency.
And I'm guessing the smart contract makes sure both sides happen at the exact same time.
Right. If one side fails, the whole transaction cancels automatically, so there's zero settlement risk.
That's wild. And the big takeaway for you listening is really about where you should be paying attention. It's so easy to get distracted by volatile crypto prices on social media.
Oh, absolutely. The noise can be deafening.
But the real winners of this structural revolution aren't the people day trading digital coins. It's the infrastructure companies, the data oracles, the secure custodians, the compliant software builders.
Yeah, traditional banks aren't dying out like early crypto advocates predicted. They're just absorbing blockchain to upgrade their own plumbing.
Okay, I love the optimism, but nothing in finance is a frictionless utopia. If we're automating collateral moves, what happens when something inevitably breaks? Based on the analysis, what are the actual blind spots here?
The research highlights 4 major risks, and the first one is legal rights. It's arguably the messiest.
Let me play out a worst-case scenario. Let's say the smart locker gets hacked, or there's a bug, and my digital token just vanishes.
Right, or the platform running the ledger goes bankrupt.
Exactly. With a physical code check, even if I lose the ticket, I can talk to the manager and prove the code is mine. Who do I call when the blockchain fails?
That legal ambiguity is a huge issue. The DTCC says the digital token has the exact same investor protections as the traditional asset. But, and this is a big but, it hasn't been stress tested in a major bankruptcy court yet.
So if a system crashes, the priority between the guy holding the digital token and the guy owning the physical asset could turn into a legal nightmare.
Yeah, until case law is firmly established, that inherent risk remains.
Basically, it works great until a crisis hits, and then you're at the mercy of corporate lawyers. Okay, what's the second risk?
Interoperability. Right now, major banks are experimenting with different blockchains. JP Morgan have theirs, Goldman might use another, the DTCC is building their own.
But aren't blockchains basically walled gardens? They all have different code and security, right?
Yes, and that is the problem. If JP Morgan's ledger can't talk natively to Goldman's ledger, we're right back to where we started.
It's like trying to build a national railway, but every state uses a different width for their train tracks.
Exactly. If they can't establish standardized rules, scattering these assets across incompatible networks will actually ruin liquidity instead of helping it.
Which leads right into the third risk. Let's say they do fix interoperability and collateral is moving instantly, 24/7. That sounds like an operational risk nightmare.
Because the speed of the system becomes its own vulnerability, right? Moving collateral 24/7 means you need 24/7 risk management.
Right. If Chainlink has a glitch or a smart contract executes a bug at 4 a.m. on a holiday, there are no humans awake to hit the emergency stop button.
And in traditional finance, circuit breakers pause the market when things go crazy. If atomic settlement happens in milliseconds, an error could shock the entire core infrastructure before anyone even wakes up.
A flash crash at the speed of light. The same automation that makes it efficient strips away the human safety net.
Exactly. Which brings us to the fourth and final risk: regulatory limits.
Meaning the government isn't just going to let Wall Street run totally wild with this tech.
Right. It's crucial to remember that the SEC's green light is just a 3-year conditional pilot, and it is strictly limited to the safest, most liquid assets like U.S. Treasuries.
So it's not a free pass to tokenize complex, volatile assets on public chains.
Definitely not. If people look at this pilot and think regulators just bless the whole crypto industry, they are vastly misinterpreting the situation. The regulatory perimeter is moving by inches, not miles.
They're dipping a toe in the water, not doing a cannonball into the deep end. Well, we've covered a tremendous amount of ground today. Let's summarize the core insight for you listening.
Sounds good.
Despite the flashy headlines, Wall Street isn't turning into a crypto casino. Institutions like the DTCC are just using blockchain for a quiet, massive back-end upgrade. It's a high-tech smart locker system to make U.S. Treasuries move faster and cheaper.
Yeah, by using intraday repo and smart contracts, they're freeing up massive amounts of trapped capital and modernizing the plumbing of traditional finance.
Exactly. And it leaves us with a really provocative thought for the future.
Yeah, it really does. Think about it. If this hybrid infrastructure works and global collateral can suddenly move instantly, 24 hours a day, 7 days a week, how does that change our relationship with time?
Wow.
Will the concept of a weekend or a market close even exist for the banking system anymore? We might genuinely be looking at the end of the traditional 9 to 5 financial world.
That is a staggering thought to leave on, a global market that genuinely never sleeps and never stops settling. Well, that is all the time we have for today. Don't forget to subscribe and hit that like button.